You're listening to the All-Star Charts podcast with JC Peretz on technicalanalysisradio.com.
All right, everybody, we are back on the podcast, and my friend today, Neil Blalock, is our guest. Neil is the, strategist, founder, owner, all of the above of NJB Capital Management. Neil, thanks for being here.
Hey, thanks for having me, JC.
So you and I know each other for a long time. We see you maybe once a year if I'm lucky, and always really had an appreciation for really your perspective on things, really because it's very different to how I got into technical analysis and I got into the markets, like living in New York and doing it that way. You want to tell me a little bit about, growing up in Missouri and sort of coming from the futures side of the business?
Well, like you said, I grew up in Missouri through somewhat of a long line of agricultural commodity traders, physical commodity investors. My grandfather, I can remember to this day as a young kid, would take me to cattle markets, feedlots, where they were actually trading live cattle, where they would bring one or two or three steer heads in, and the guys and the gals around the ring would actually bid through the auction process for the cattle. Later on, my father was actually in the industry also, in the soybean industry. So it kind of goes a long story around, as that's kind of how I somewhat got into commodities. So corn, soybeans, wheat, cattle, it kind of runs in the blood.
And a lot of your friends and neighbors as well?
I've known many people throughout the Midwest that have actually been involved in the agricultural commodity industry. Not necessarily individual friends and neighbors, but when you're here in the Midwest, it's kind of a close-knit community. So everybody kind of knows everybody when you're in the industry.
And then what drove you to the sort of the hedging side, I guess?
I was in college going for a degree in finance, and like many college students, was bartending to make ends meet while going to class. And one weekend I was actually away visiting family, I believe, and came back to my school, and the bar that I was bartending at had closed. So, of course, without a job, first thing I did was grab a newspaper back in 2002, before you could even get on Google. Google hadn't even been invented yet, right? Public a couple years later. And I opened up the newspaper and was looking for a job, and I saw an ad for a commodity broker. Said, no experience necessary, give us a call. So I gave them a call, walked into a small firm there in Wisconsin, sat down, got the job, and continued to go to school for a degree in finance. But over those next 3 to 4 or 5 years, learned about the futures industry. The interesting aspect of it is I had came in right in 2002, which just coincided, luckily for me, the beginning of the great commodities bull market of the turn of the century.
Right. So the next 11 years or so, the next 10 years or so through 2011, things were pretty heavy duty.
Well, if you look at a chart, a monthly chart of gold, and I know you follow charts of gold.
Sure.
Gold really took off in 2002. So from 2002 to 2004, we were really speculatively trading gold. This was at the time where the stock market had, quote unquote, crashed. The NASDAQ bubble had popped, and people everywhere were looking for other places, other asset classes to put their capital. So it all worked out really well then. I was able to learn the industry, learn the hedging process of agriculture commodities at the same time too. And that all went great. The boom happened in 06, 07 when ag commodities really took off, soybeans and corn. I remember being long corn for over a year. The fundamental story was intact. The corn market had gone from $2 a bushel to $8 a bushel. People were thinking it was going to be $10 a bushel. We were running out of corn. The biofuel was picking up. The government was telling farmers, you got to blend corn. You got to put corn into ethanol. That was the ethanol boom. And then the global financial crisis hit. And before I knew it, the fundamental story was still there, but my $8 corn crop that I had rode all the way up was back at $3 within 3 to 4 months. After that, I realized that understanding the fundamentals of a market isn't enough to make money over the long run. And I happened to run into another commodity trader that was actually officing next to me at the time. And he had told me about this organization, formerly known as the Market Technicians Association, now the CMT. So I signed up, took the first test that winter, I believe in December 2008, while everything was melting down around me, and went to my first symposium 3.5 months later in New York in April of 2009. And that, here we are 10 years later, definitely changed my trajectory of my career and how I view markets.
It's probably where I first met you, at that event or maybe the year after, right?
Yeah, that one was been back when they were still doing it in Midtown. And I can't remember if I met you then or not. That was at the Millennium Hotel. And I believe that was my first time in New York. So that was as a late 20-something-year-old, I was pretty wide-eyed. But meeting, not sure if I met you that year or not, but just meeting so many people that I've met over the years while visiting in New York has just truly opened my eyes to different ways of seeing things.
Yeah, it's quite obvious, watching you have friends around the country that are technicians and market participants. That's pretty special. I could say the same.
Yeah, we are definitely blessed to be in a great group, great society of people. And having social media, and especially for somebody like myself that works in a small firm that I've owned now, being able to throw around ideas, have discussions, learn from people that have been doing it for much longer than me from all over the country via social media on a daily basis has really helped me too in my practice.
And then what's your day-to-day look like? Talk to me about what you're doing now, because we've joked, but I don't think you're joking. Like, you're much more into the stock market now than you are in the futures market. Can you talk a little bit about that transition?
Well, in order to make money, you got to trade when things trend, right? So over the last 4 to 5 years, it's just the commodity markets just have not trended. You get a jump start here or there in a specific commodity, and then it will just roll over really fast. And I mean, commodities obviously have a downward deflationary aspect to them. The more progress human man makes, the more pushes prices down of commodities. And it goes back to the price thing too. The reason that we've doubled crude oil and shale output over the last decade in America is because crude oil went to $147 a barrel. We would never be energy independent if that would not have happened. The same thing has happened in ag commodities. When soybeans rose to $15 a bushel, corn to almost $8 a bushel, the growth of the acreage, not only in America, but more specifically South America and all over the world to grow these physical commodities, continues to trajectory go up over the years, which has pushed deflationary prices down. So over the last 4 to 5 years, as I believe the new secular bull market in stocks has continued to take off and build out, I just thought it was right for me to continue to move more that way as I try to offer more expertise to any client I have.
And using technical analysis, you can go from commodities to equities to Forex to ETFs. Doesn't matter?
That's correct. As you know, the great thing about at the end of it all is its price. We understand that there's a lot of different factors that go in how prices are closed at the end of the day in commodities, in stocks, in bonds, in currencies. But at the end of the day, the price is still the only thing that pays us.
All right. Well, you talk a lot about how the commodities market has just done nothing, right? Specifically, you look at charts of corn over the last 5 years, coffee, cocoa, wheat is another great example, just sideways, choppy, messy mess, as I like to say. Who's to say that these aren't just massive bases?
Well, JC, that's interesting that you bring that up. I think they might be massive bases. Let's take a look. And I know you spoke about the CCI index, the CRB index. Both of them seem to have bottomed back in 2016. And for the past 3 to 3.5 years, have just slowly consolidated and built the base. It's funny that we look at some of these, like let's bring up the CRB index, for example.
Yeah.
The top was made in 2008.
Yeah.
And how long did it take? 6, 7, 8 months for the CRB index to drop 57%?
Yeah.
It rallied back up into 2011. And then from 2011 to 2016, it dropped another 57%. The exact equal drop that it initially dropped coming off the top of the secular bull market in the CRB.
Yep.
If we look at TCI, which, as you know, takes energy out of it, or not, doesn't take it out of it, but definitely lessens the effect. It dropped 66% in 2008 going into 2009, rallied back into 11, and then dropped 65% before it bottomed in 2016. So these 100% progressions of each drop are definitely eye-opening. At the same time, what we've had over the past year or two with the trade war, let's say, without getting political here, would seem to be put even more deflationary pressures on commodities, but yet they haven't made new lows. And I bring the trade war up because this is the exact type of sentiment headline that you would expect when that aircraft carrier is slowly turning. And make no mistake about it, it is slowly turning, and it can take many, many years.
So you think that this is a major bottom in a lot of these commodities, and we're going to have times again where we're going to be talking about commodities. I remember like talking about commodities every day back then. I kind of miss those days.
Well, it's fun to talk about things that nobody else talks about. And I agree with you.
There's been nothing to talk about, though, regardless
I
of who you
agree
are.
completely. I think let's talk about the U.S. dollar with relation to commodities, too. I mean, the dollar made its high coming after the election, in 2016 election, and then fell off going into bottom 18, and it hasn't made a new high now in, 3 years?
Yep.
So, of course, if we're going to talk about commodities making the turn, the one thing that has to happen is the U.S. dollar has to have topped a couple of years ago, in my opinion. And as we've got this throwback rally going on now for the past 18 months, if this slowly starts to peter out here, maybe we can be looking at the next, I'm not going to go as far as say super cycle bull market for commodities, but a 2 to 4 year run in commodities could change a lot of people's perception of them again.
All right. Well, let me kind of throw this at you. I mean, it's hard for me to disagree with if commodities are going to have another monster move like we've seen in the past. A weaker dollar just makes sense in that environment, right? Okay, fine. We're talking about the dollar index more specifically. We're talking just about a bunch of euro. Like,
correct.
Where does the U.S. dollar is the sun and all the other currencies are sort of the planets running around it? How does that fit in, right? You feel me? How does that fit into this situation?
Well, I mean, it's basically if you just flip the chart of the dollar upside down, you're looking at the euro, right? I mean, the euro bottomed in December 2016. The same month, the U.S. dollar topped.
Right.
Now, your question is, how does it fit into it? That is a great question, and I can honestly say that I do not know the answer to it. That's why I studied the price chart of the euro and the dollar, and that's going to give me my answer. Sometimes it's better to know what it's doing than to be able to explain why it's doing that. I'm going to assume as soon as I figure out why I think why, I'll probably be wrong. But as long as the price chart tells me I'm right, I'll go ahead and continue with the thesis.
So you don't think there's any way we have a super cycle in commodities without the dollar getting slaughtered like it did last time?
I mean, it would be hard pressed to think that it's possible. And not necessarily the dollar needs to be slaughtered. It just needs to stop going up. And I believe it has stopped going up over the past couple of years. Now, it has trended up slowly in a corrective nature over the last 18 months, but it's still below that peak from late 16. Something that also brings to mind talking about this dollar here is the kind of about face that the Federal Reserve did this summer when they started worrying about deflation a little bit more than inflation. You can go back and read Murphy's intermarket analysis book where he talked about when the Fed first started worrying about that in 2002, worrying about deflation over inflation and causing a weaker dollar. Well, maybe that was the reason that kicked off that secular bull market in commodities.
What is one commodity you like now? There's got to be something out there that catches your eye, because correct me if I'm wrong, like you could take Neil out of the farm, but you can't take the farm out of Neil.
I've moved around a little bit across the Midwest, but I've never really left the Midwest. So I guess you could agree with that. That's a good question. Copper has definitely turned my eye here, along with it bottoming in late 2016 when the dollar topped and has been consolidating for the past 18 months, slowly trickling back down a little bit, but it seems as is a corrective move in nature. But I'm going to stick with the bread and butter here, and I'm going to have to call for soybeans.
You couldn't help yourself.
I just can't, JC. I just can't. Let's talk about soybeans for a little bit here. Soybeans are the direct target of the trade war with China. It has the biggest ramifications with soybeans. Now, make no mistake about it. The trade war has not pushed soybeans down. Soybeans were already going down way before the trade war happened with China. And again, this goes to show you that sometimes the discussions that we have at the bottom of a secular move is when the news is the bleakest. So if I'm studying, let's take a market vein that kind of looks at the Commitment of Traders report with soybeans, the bullish consensus is the lowest since 2001. Now, sentiment, as you know, is not applicable to be a trading strategy without other stuff. I look at a monthly chart of soybeans, and they just did an outside reversal not 2 months ago in September of 2019. The first outside candlestick reversal that we've seen since March of 2015. That went ahead and preceded about a 35 to 40% run in the soybean market before giving it all back. But we just saw that again happen here 4 years later. So are we at the beginning of another bull market in soybeans? That's a good question. Of course, things have to happen supply-wise for that and demand-wise, but we never know what can happen in the future. But what we do have now by the chart is we have a set risk parameter that we can use to make bullish bets on the market and know when we're wrong.
So where do you know you're wrong on the bullish bean trade?
I would not want to see front month soybeans trade under 850, the low of September. Again, we ran from 850 to about 950, which is about a 15% move. We've slowly pulled back, not even quite 50% of that here. We will learn a lot more this winter of the fundamentals of the crop that the producers just grew here in North America. And at the same time, the farmers down in South America are growing their crop. So if we didn't get what we expected here, and there's any hiccup aligning in South America, and if we can get an agreement on tariffs being taken away from China processors buying soybeans out of the United States, I think we have the fuel for the fire to make a move up. Where does that move go? I can't tell you that. I just know that right now we have a great risk-reward ratio in place to make a trade for it.
And not for nothing, we're at the lower end of the range where it's been rallying from for a decade. So it rallying from here would not be this earth shattering, right? You know?
No, no, not at all. And another thing too, take soybeans, take crude oil. You know, these commodities have still bottomed out here in the last decade at a much higher price than they were before the super cycle happened. You know, soybeans going back to 2002 were trading at $4.75 a bushel, and they bottomed out at roughly $8 a bushel. That's a substantially higher price. Crude oil was trading at $17 a barrel in 2001. And when it cratered in 2008 and early 9, it stopped at about 33, rallied back to 100, broke down again under 30, and here we are finding a floor in the 40 to 60 range.
And what about the bean oil and the bean meal? You trade those?
Of course, they're products of the soybean market. I don't believe you can have a true soybean bull market without a soybean meal bull market. I trade the meal a little bit. I do not trade the bean oil. I do not trade the palm oil futures. I understand the ratios between them, but I've never had any use to trade them for hedging purposes or for spec purposes. When I'm already so intertwined with the soybean market, it just seems kind of redundant.
That's fair. Let me go back to what you were talking about earlier on the commitment to traders report, and you actually briefly mentioned copper before Farmer Neil took over, and we went back to the soybeans. You mentioned the commitment to traders report. Copper commercial hedgers have had on their largest net long position ever, right? And meanwhile, the gold commercial hedgers have on their largest short position ever. So that's just like a really interesting positioning from a base metal, precious metal standpoint, no?
You know, I think we could all learn a lot from commercial hedgers. I wish all of our pocketbooks were as big as them, but when they are on the right side of a trade, they will be very patient to be paid off. And more times than not, they know what they're doing. As you know, they're in the industry. They're the ones that are actually using these physical products on a day-to-day, week-to-week basis. So the fact that copper has pulled back over 18 months while commercial hedgers continue to build that bullish position makes me even more bullish when I can get the right risk-reward strategy to go forth with that trade. And as you said with the gold too, yeah, I mean, gold rallied up. It tested its breakdown from 2011, 2012. It could never get above that. Which that in itself is interesting for me. The gold market actually broke within a couple months of the secular bull market and stocks taking off in 2013. So I can't be bullish gold here, even though that seems contradictory to me thinking the dollar has topped. I don't necessarily believe gold has to rise just because the dollar is not rising.
Yeah, you saw what happened this year. Gold had a killer year and dollar was flat, right?
Correct. You know, and what makes me not be able to hop on this gold bull train either is look where gold came back up to. It came back to retest the bottom of its speculative blow-off in the early part of this decade. But what did silver do?
Nothing.
You know, I mean, if we're going to have a true bull market in the metals, in that metal, I got to believe silver's got to be leading it sooner or later. And it didn't come close to reaching those levels that it saw last in 2011, early 2012.
No way. When I look at I look at silver as like gold's like crazy little cousin, right? And whatever gold's going to do, this is just going to tag along, but do it in a crazier way, right? So, if gold's going up, silver's going to rip. If precious metals have a real bull market, and when gold gets hit, silver gets slaughtered. I mean, that's just the way that market works. And we've done the work. And if people are bullish precious metals, silver's outperforming. I mean, that's just what it is. And you're absolutely right. It's a great call. Didn't happen. And where did gold rally to? To former support from 5-6 years ago, which is perfectly normal. In fact, we should be expected to be trouble. It's like running into like Ray Lewis, just like ready to just pound you. Like it was very, very clear, which is why it had been our target. Now, sticking with the Commitment of Traders report, they have on their largest net short position ever, right? Gold hedgers do, ever. Go back a year, 13 months or so, and they were actually net long of gold. And
That's correct.
I don't think they've ever been net long prior to that. Am I right? I'm serious.
I think maybe they were net long in 2007, 2008. I don't know if I could find the Commitment of Traders going back that far without digging through the archives. But that would be the last time that I remember them being net long.
Not the point, right? They were,
Exactly.
really long. They're never long. They were actually long, and gold absolutely ripped. They nailed it, and now they have the exact opposite position. So why on earth would anybody want to get in front of that train?
At the same time, too, Managed Money continues to have hundreds of thousands of contracts long gold up here right now. So who's going to be right in the long run?
Yeah, I'll take the commercial hedger side all day long. So, and just to reiterate, people listening out there, when it comes to sentiment, Neil agrees with me. The 90+% I would say is completely useless. We really only want to pay attention at extremes. Would you agree with that, Neil?
That's correct. Yeah, it's no different than any other a stock or anything like that. It can move to extremes. When it does is when our ears got to be peaked and see when it blows off.
And usually it's not. So, right?
Yeah,
usually
correct.
It's not by definition at an extreme. All right, so hold on.
Yeah.
I want to get a little bit more meta philosophical here. Okay, ready? So copper commercial hedgers largest net long position ever. Gold commercial hedgers largest net short position ever. When you overlay a ratio of copper versus gold, it looks exactly like the U.S. 10-year yield. So correct me if I'm wrong. Commercial hedgers are positioned for bonds to get slaughtered, no?
It seems like that, especially after we just saw the largest 1 week pull out of the TLT in 10 years just last week.
I never really understood sort of the ETF money flow thing. I've never been able to really wrap my head around how that works. I would love for you to explain it. How do you use that?
Well, I don't use it. It's kind of a sum of all parts things, like you like to say. It's definitely not actionable in and of itself. It's no different than, the last time we had a big pullout was in late 2018. That didn't necessarily mean the stop of the bond bull market by any means. So it's just one of those things. You got to chalk it up. You got to put it in the back of your head and say, I know it's there, but is there going to be a trend of it? I mean, 1 week doesn't make a trend. Will we start seeing it happen week after week?
Got it. That makes sense. I've always found the Commitment of Traders report when hedgers and specs are at extremes to be much more helpful, particularly in precious metals, in bonds, in those sort of markets. We have had a tremendous amount of success. I mean, you could just go back and see when they're at extremes, like markets turned. Like it's not, we're not reinventing the wheel here.
That's correct. And the Commitment of Traders report is extremely useful in the ags too. I don't know how I could ever make long-term decisions to help clients in the ag markets without it.
All right, that's fantastic. On the intermarket note, when we talk about looking at a copper gold ratio, overlaying interest rates and things like that, what we're doing is it's that cross asset analysis. Do you incorporate that in your day-to-day?
I do not with regards to commodity. For the clients that I have, they're usually commodity specific, so I need to focus on that. I do cross asset analysis between bonds and stocks, between commodities and bonds, between commodities and stocks, but not between commodity and commodity like you do. I do enjoy reading your work on what you do also, though, and I learned something from that. I've just never been able to use that as an applicable tool to help my business.
Yeah, I could see that particularly on the agricultural because they're sort of like their own unique animals. No pun intended there. But like something like, how the bond market feels about inflation, right? You talked about deflationary forces and inflationary forces. When you see like inflation protected treasuries versus non-inflation protected, things like that, I'm able to see how the bond market feels about future inflation, right? Do you feel me on that?
Yes, I do. Yep. I understand that completely.
Yeah, I think that makes a lot of sense, and I found it really really helpful in the past. All right, so what's something that we're not talking about here? Is it palladium? Palladium doesn't get enough attention. It's too busy making all-time highs. What stands out that we're missing?
Have we talked about any soft commodity? Have we talked about coffee yet? Yeah, everybody keeps waiting for the next coffee bull market to happen, and it's one of those commodities that kind of jump starts its engines for a month or two, and then just makes new all-time lows again a couple months later.
City Kid's got a question over here. So how do you, and I've seen the list, but how do you differentiate between, I've had this conversation before with other people who have wondered the same thing. How do you differentiate the difference between ags and softs?
Well, ags are soybeans, corn, wheat, cattle, hogs. Uh, Softs are, your sugars, your cotton, your coffee, your cocoa. Coming from the Midwest, here's how we differentiate it. One is traded or used to be traded live on the Chicago Board of Trade, and the other one was out in New York, where all the city guys were trading the softs. So that was the big difference for us coming out of the Midwest, or at least me, how I learned to trade the market.
Because the ags were primarily out of Chicago and the softs were primarily out of New York?
That's correct. The Board of Trade, Chicago Board of Trade was having, your soybeans, your corn, your wheat pits. And then you had to go over to the the Chicago Mercantile Exchange. And that's where the cattle pit was, and the lean hog pit. And it's funny, I've been at these pits before. And then right next door to it is the huge bond futures pit, which has got way more people in it. So definitely interesting times. I wish the pits were still around.
Yeah, I mean, I was just there. Last time I was down there was probably a couple of years ago, and I mean, there were just a bunch of empty pits everywhere. And then, like, I think like VIX and S&Ps or something were the only ones. Just a bunch of people, unfortunately, watching like cat videos and stuff, right?
And what did they have in their hands last time you were there? They're sitting there trading on their iPads in the middle
Yes.
of a pit. There wasn't even open outcry anymore. They were all taking orders electronically.
Yeah, or taking lunch orders.
What else do we miss here? One thing I did want to bring up, moving over a little bit to equities here, is I think the underperformance of the small caps the past year is extremely bullish. I'm a believer that we did at the beginning of a cyclical bull market with this breadth thrust that happened earlier this year, and small caps usually don't lead to start out the beginning of it. So if we can get the Russell to break out above the 1600 level, I'm extremely bullish on small caps, and that kind of coincides with the dollar not continuing to move too much. If we just get a steady pace, I think we're going to rotate back after this initial value rotation we've seen the past couple of months. I think when we get speculative again, I think they're going to be reaching for small caps.
If small caps are going to do well, I mean, the financials in small caps is twice the weighting as it is in the large cap space. So isn't like a rising or small caps catching up evidence of regional banks and financials also doing well, which makes sense with higher interest rates and lower bonds? Is that where your head's at?
That's correct. That's exactly what I see.
I was talking with Rob Sloimer the other day. Really smart guy. Really looks at the markets through a similar lens as I do. We had an excellent conversation on the podcast. Definitely check it out. And he was really in the camp, and as much I've been more like, I feel like hands off. I feel like I haven't been as bearish bonds as I probably should have been. It was kind of just like, we just want to get out of the way and just buy stocks and not worry about what's going on in the bond and gold market. But he was like really bearish of bonds, and kudos to him. I'm starting to kind of be more into his camp, as a matter of fact. But he was the one who was kind of really bringing that to my attention, which is why I love having these conversations, because it kind of, hearing different things from different people, really, really kind of maybe opened my eyes to maybe I'm not bearish gold and bonds enough, right? As bullish as I am of stocks, maybe I should think of the other side a little bit more, which I guess makes sense. Right? If stocks are going to we're going to have a ripper and no one's going to get a chance to get in, gold and bonds are probably getting hit pretty bad there, right?
Agree. I like the the fact that this year, the 30-year, the interest rate made a new low, but the 10-year didn't.
Right.
And I don't think that is discussed enough. That new low in the long rates was not confirmed with the 10-year. And it did not last long at all. And it's changed rapidly. And you're absolutely right. I met Rob years ago out there in New York, and definitely one of the smartest guys in the business. I did listen to that podcast the other week you had with him. Excellent podcast. The guy knows what he's talking about, and I think he might. Are we finally going to get the secular shift that we've all talked about, me and you have looked for our whole lifetime?
Yeah, I wouldn't say I've been looking for it, I suppose, but I figured it'd be coming at some point, right? I probably figured it'd be coming already, really. If you would have asked me at any point in my career prior to now, I would probably say I would have been here already, right? When is that going to happen? Are we ever going to see rates going up?
That's a great question. And that's one market that's jump-started numerous times too, only to roll back over.
I'm kind of in the camp with Robert Sloimer on the bonds and the gold, and I think we're all on the same page. So I guess fade us, right? Everybody listening out there, fade us, buy bonds, buy gold, short stocks, right?
There you go.
All right, well, let me ask you one more thing from a risk management standpoint, which I'm confident technical analysis helps you there. For people listening out there, how important is risk management, regardless of what markets you're in, and how do you use technicals to help you do that?
It's the number one thing, JC, as you know. Any trade that we put forth, any position we take, whether it's a commodity, a currency, a bond, an individual stock, anything, before we get into a trade, we know we're out. We put our stop loss in there. There's certain times you hit your stop loss, you wish you would not have got out. You can always get back in. I learned the hard way, as we all have in the past, is, I would much rather be out of a market wishing I was in than in a market wishing I was out. And I have that pasted right here in front of my, next to the left of my monitors, and I read it every day.
It's good advice to put little notes around to remind yourself of things, particularly the most important things. And I think, like you said, I'm not going to argue with you. Risk management, obviously the most important thing. You're not going to get any arguments from too many people that are guests on this podcast either. But Neil, man, we've been trying to do this for a while. You're busy. I've been running around myself, so I'm glad we were able to catch up. We should absolutely do this again.
Yes, it's been great. I'm glad we finally got together for this.
You bring an interesting perspective that maybe more hardcore equity or global macro guys might overlook. But I appreciate it, Neil. Thanks, man.
Yeah, not a problem. Maybe next time we talk, we'll be in the middle of the next secular bull market and ag commodities.
All right, I'm all for it. I'm down for whatever.
Thank you for listening to the All-Star Charts podcast with JC Peretz on Technical Analysis Radio. To see all of the charts mentioned on today's show, please visit allstarcharts.com/podcast.